Imagine a business that is making sales every day, but suddenly it can't pay its bills. That happens when working capital is low. In this video, you will learn working capital through simple real world examples. Working capital is the money a business uses for day to day operations. Even a profitable business can run out of cash if working capital is not managed well. You will also learn how to identify cash gaps before they become a problem. Stick with me because I will show you the exact warning signs that many business owners miss. For example, a small store can sell lots of products, but if suppliers need a payment before customers pay, cash can get stuck. That creates a cash gap. In this video, you will learn how to spot this problem before it becomes a crisis. I will show simple signs that many business owners miss. Do you know if your business is cash positive or cash negative? Working capital is the money a business has available to pay short term bills. Working capital is calculated by subtracting current liabilities from current assets. It tells you whether a business can pay its short term bills. This is different from profit, which is more about long term performance. Think of working capital as the business's cash buffer. If this buffer is small or negative, the business can struggle even when sales are strong. For example, a shop may sell a lot but still run out of cash if bills are due before customers pay. Do you know if your business has a healthy cash flow? Cash is what keeps a business running every day. It helps you manage inventory, pay suppliers, and cover payroll. If you run out of cash, the business can face a crisis even if sales are strong. Working capital matters because Working capital matters because cash can get stuck in inventory or unpaid invoices that can create a shortage. This is especially important for freelancers and small businesses where cash flow is tight. Working capital helps you plan and avoid sudden money problems. A grocery store often has positive working capital because customers pay cash immediately. Suppliers are usually given 30 days to pay. When cash comes in fast and expenses are delayed, the business has a healthy cash flow cycle. This helps the store operate smoothly and avoid cash gaps. In manufacturing, the business pays for materials early, but revenue comes later. Production takes time, often around 45 days. Customers usually pay after 60 days. This creates a cash gap between spending and receiving payment. This is the classic reason many manufacturing businesses need working capital support. Even with strong sales, the cash gap can be significant and cause problems. What if working capital becomes negative? Negative working capital is a warning sign that a business can't pay its short term bills. Many businesses reach this situation without even noticing. This is where most businesses get stuck. This creates a cash shortage risk. Such a business will face operational issues. For example, a business has loss of inventory or unpaid bills, but not enough cash to pay suppliers or employees on time. A store has lots of stock, but sales are slow, so cash gets stuck in inventory. You might see delayed payments, late supplier notices, or the business borrowing money just to cover daily expenses. Why it happens? It happens when cash comes in slowly, but bills are due quickly. A retail store can face negative working capital if inventory is not selling fast. The cash is stuck in stock, but bills still arrive. This is why inventory management is a key working capital skill. Slow moving stock can quickly turn into a cash problem. Don't worry, I will soon give you a practical skill set to improve your skills. to manage your cash properly. Positive working capital happens when cash comes in faster than it goes out. Quick sales and fast customer payments help maintain a healthy cash buffer. Even small changes like faster invoicing or better payment terms can improve working capital significantly. But the working capital ratio shows liquidity. A ratio above 1 means current assets exceed liabilities. A ratio below 1 is a warning sign. Different businesses have different needs, but the ratio helps you compare and track changes over time. Here are practical skills you can apply immediately. Track cash inflows and outflows. This gives you control over working capital. You should know exactly where your cash is moving every week. Monitor inventory turnover. This helps you move stocks faster so cash doesn't get stuck. Slow inventory is a common working capital problem. Improve invoice collection. Ask customers to pay sooner or follow up on late invoices. This helps cash come in faster. Negotiate supply terms. Try to get more time to pay suppliers. Even small improvements can make a big difference. Freelancers also need working capital. When invoices delay, expenses continue. This creates a cash flow problem, even if it's on a smaller scale. Keeping a cash buffer helps freelancers manage slow payment cycles. It reduces stress and keeps work running smoothly. Now is your turn. Think about your business or freelance work. Are you cash positive or cash negative? What is your biggest cash gap? Comment your answer below. I will respond with suggestions based on your situation. This helps you apply working capital in real life. Here are practical steps you can implement this week. Reduce slow moving inventory. This frees up cash that is stuck in stock. Improve invoice collection. Ask customers to pay sooner or follow up on late payments. This brings cash in faster. Track cash weekly. This helps you see where money is going. It keeps you in control. Use a working capital template. It helps you track cash and monitor trends. This keeps you organized and positive. Working capital is the real fuel that keeps your business running. It shows whether you can pay bills and continue operations smoothly. Cash gaps are the biggest risk for any business, even if sales are strong. If you want more simple real life finance lessons for freelancers and small businesses, subscribe and hit the bell. Thank you very much.